this video, we're tackling the question where to save an emergency fund. Before we dive into the specific account options, let's talk about what you should look for when choosing an account. The primary goal of an emergency fund is to protect your money and provide you quick access when you need it. You want to view your emergency fund like a self-insurance policy rather than as an investment. So the two key ingredients we're looking for are safety and accessibility. Safety is of course extremely important. You obviously want to be able to sleep at night knowing your emergency fund has a zero chance of disappearing. So make sure your account has insurance coverage from the FDIC or the NCUA. This insurance protects your money up to a certain limit, usually $250,000 per depositor per insured bank, meaning even in the worst case scenario, your funds are safeguarded. You can go to fdic.gov or ncua.gov to make sure your institution is covered. Accessibility is also super important. As we know, emergencies strike when we least expect them. So you want to be able to access your emergency funds without delay or any penalties. Where you hold your emergency fund should allow you to withdraw your funds easily and quickly, either through online banking, an ATM, or an in-person visit. Now, you could argue that your checking account is a safe and accessible place to hold money. And so it could be tempting to leave your emergency funds muddled up with the funds in your everyday checking account. But I do not recommend this. Keeping your emergency fund completely separate from your everyday checking account is key. The separation of the two accounts can really help you avoid the temptation of dipping into your savings to cover everyday expenses. Plus, the accounts we will talk about let you earn a higher interest rate than any typical checking or savings account will offer you. The rates are subject to change, and they increase or decrease as the Fed raises or cuts interest rates. In the high interest rate environment we're in at the time of recording this video, the accounts we will discuss are offering interest rates substantially higher than they were in 2022, especially in 2021, so it's important to know what your options are. I do want to disclaim this. The higher interest rates you'll earn won't be life-changing in terms of wealth building, but remember, this is not the purpose of your emergency fund. We just want to earn the best possible return on this money to protect it from inflation. That's all we're aiming for. Investing is what's going to help you grow your wealth, and that's a topic for another day. So now let's look at the account options. First up, we have the high-yield savings account. High-yield savings accounts are extremely popular for emergency funds, and it's easy to see why. Basically, a high-yield savings account is just like a regular savings account, but with a little extra oomph, in that it offers a higher interest rate. To put things into perspective, in the US, the current national average interest rate for savings accounts is 0.42% APY. Some of the biggest banks are offering interest rates as low as 0.01% on regular savings accounts. But high-yield savings accounts are currently offering APYs upward of 4%. That's a 400 times higher return than a regular savings account. Again, it's worth noting that high-yield savings accounts rates do go up and down as the Federal Reserve raises or cuts interest rates. But even in a low interest rate environment, high-yield savings accounts outperform regular savings accounts. Now let's talk about safety and accessibility, our two key criteria when it comes to an emergency fund. Long story short, high-yield savings accounts have you covered on both fronts. First, they're typically FDIC or NCUA insured, which means your money is protected. Safety, check. And you have the flexibility to access your funds whenever you need them without any penalties. Accessibility, check. It's not common for a savings account to offer a debit card for purchases. However, some do offer an ATM card for withdrawing cash. For most high-yield savings accounts though, you'll need to transfer your money into your checking account and then spend from your checking. Keep in mind that you may be limited to a certain number of free withdrawals per month, and transferring between banks could take up to 24 to 48 hours. But hey, we're talking about emergency funds here, not daily spending. So these seemingly inconvenient characteristics actually make high-yield savings accounts the perfect home for your emergency fund. To get the best rate, online-only high-yield savings accounts are absolutely the way to go. Banks like Ally, Marcus, and SoFi operate purely online and have way lower costs compared to traditional brick-and-mortar banks like Bank of America, Chase, or Wells Fargo. And what this means for you is higher interest rates. but be on the lookout for minimum deposit or minimum balance requirements and monthly fees. These days though, it's easy to find a no-fee account that offers a competitive rate. By keeping your emergency fund in a high-yield savings account, you're protecting your money while keeping it accessible. And the icing on the cake is that you'll be earning a competitive interest rate to help protect your money from inflation. If I wanted to keep this video nice and short, I'd honestly stop here and say, don't overthink it. Go find yourself a fee-free high-yield savings account offering a competitive interest rate and start using that to store your emergency fund. That's what I do, go. But I think knowing your options is important. And so I wanted to share some other potential options while talking through the pros and cons of using them as an emergency fund. So next, let's talk about money market accounts. Not to be confused with money market funds, which are investments. A money market account is an account that combines the features of a savings account and a checking account into a single deposit account. Like high-yield savings accounts, money market accounts are typically FDIC or NCUA insured, meeting our safety requirements. Safety, check. And they also let you earn a competitive rate that goes up and down as the Fed raises or cuts interest rates. One way they differ from a high-yield savings account is that they make your money even more accessible by offering you debit card access and/or check writing privileges. Accessibility, check. This could be a great feature in an emergency, but it could also make it easy to tap into the money for non-emergency expenses. So that's something to keep in mind if you choose to use an MMA for your emergency fund. Also with MMAs, some have minimum balance requirements, either to open an account, earn interest, or to avoid fees. So be on the lookout for that. Next, we'll talk about CDs. If you're new to the concept, CDs are certificate of deposits. You can think of them as turbocharged savings accounts. With CDs, you agree to lock up your money for a specific duration, usually a few months to a few years. This is called the maturity term. And in return, banks will generally pay you a much higher interest rate over the term compared to a regular savings account. Unlike the interest rate offered by high-yield savings accounts and MMAs, the interest rate on CDs is fixed over the maturity term, and generally, a longer term means a higher APY. Once your CD matures, you have the option to either cash out your initial deposit and the interest earned into your checking account, or you can just roll over the entire amount into a new CD. So now we know CDs earn a good rate, but let's talk about safety and accessibility. CDs are considered safe because they're typically insured by the FDIC or the NCUA. Safety, check. When it comes to accessibility though, this is where CDs fall short when it comes to storing your emergency fund. Unlike high-yield savings accounts and MMAs, accessing your money in a CD isn't as simple as transferring it out or withdrawing it immediately. You have to wait until the CD matures, which could be several months or even years. And if you wind up having to cash out a CD early, you'll have to pay an early withdrawal penalty for doing so. So it's usually a good idea to only deposit money you won't need in the near future. That's why I'd advise a bit of caution when it comes to parking your emergency reserves in a CD or even something like a savings bond. For example, Series I savings bonds help your money keep pace with inflation, but you're not permitted to withdraw the money for the first year. And if you withdraw the money within the first 5 years, you'll be hit with a penalty. Don't get me wrong, these tools are great, but in my opinion, they're better suited to other savings goals. Now, if you do have a substantial and fully funded emergency fund, let's say over a year, and you don't anticipate needing a portion of that within the next year, I can see a case for you putting your money into a CD or a savings bond using a technique called laddering. Feel free to look it up. I'm not going to cover it here because for me personally, it just adds a layer of complexity that I wouldn't want attached to my emergency fund. When it comes to emergency funds, like we've been saying, quick and easy access is key. And that's why high-yield savings accounts or money market accounts are the best options in my opinion. Plus, with the current competitive landscape, you can find accounts offering attractive returns without any strings attached and without any handcuffs on your money. Before we wrap up, I want to talk about investing accounts. The reason why investing accounts haven't been discussed here is because, again, you want to view your emergency fund as a self-funded insurance rather than as an investment. Investment accounts lack FDIC insurance and come with the risk of potential loss of your principal, and you don't want to be exposing this money to market risk. When the market takes a nosedive, during times of recession or global uncertainty, that's often when unexpected emergencies like losing your job tend to arise. The risk just isn't worth it. Your emergency fund is there to protect you in the short term, and your investments are there to secure you for the long term. So we have to stop FOMOing over the interest we could earn by investing our emergency fund. It's not the purpose of this money, period. And that brings us to the end of my series on emergency funds. Thank you so much for tuning in. If you found this series helpful and informative, it would mean the world to me if you could show your support by giving this video a thumbs up and subscribing to my channel. Your engagement helps spread the word and allows me to reach even more people that can benefit from information like this. As always, feel free to share your thoughts, questions, and any feedback you have in the comments. Thank you for watching and see you in the next video. Bye for now.